what's up you guys, and welcome back. And today I would like to talk to you about Roth IRAs. Yes, Roth IRAs. And I'm gonna try to simplify it so it's not overcomplicated, so you just get the general idea of how Roth IRAs work. So first things first, the actual term Roth IRA, it comes from a tax designation that the IRS uses. They use these on several different types of retirement accounts like the 403b, 401k, etc. The name Roth actually came from a senator back in 1997 that helped create the Roth IRA. The IRA part stands for Individual Retirement Account. And essentially the name provides a shelter, a tax shelter for anything that's within that designation. So you can have stocks in a Roth IRA, you can have savings accounts in a Roth IRA, you can have cash, you can even have real estate in a Roth IRA. The term Roth IRA really is just a designation to show that the accounts that are in the umbrella of that name are for retirement purposes. So one of the biggest benefits of a Roth IRA is that it grows tax-free until you're 59 and a half. After that, you can make withdrawals from your Roth IRA account tax-free, meaning you don't have to pay any income tax on those withdrawals. And that's essentially the key feature in a Roth IRA, is that later in life, you're able to make withdrawals without having to pay taxes on those funds, which makes the Roth IRA so valuable to so many people. And the reason why it's a benefit after 59 and a half it's because it's to incentivize people to actually save for retirement. Let's just face it, Social Security is not gonna be enough for the average person to retire on. Now, although you're able to make withdrawals from your Roth IRA tax-free, there is no tax shelter up front, meaning that all the contributions are after tax. So once you get paid and all your taxes are paid, then you can make contributions to your Roth IRA. And you can't deduct any of your contributions on your tax returns either. Another thing to consider is the maximum contribution for a Roth IRA is currently $6,000 a year or $500 a month. And that's per individual. So if you're married, you and your spouse can both contribute the max $6,000. So you can contribute $6,000 a year and your spouse can contribute $6,000 a year. And since Roth IRAs are to incentivize people to save until they're 59 and a half, they do place 10% penalties if you withdraw before then. And you would also be charged income tax on any of the capital gains that you receive in the withdrawal. However, you do not pay any taxes on your original contributions to the Roth IRA. So for example, if you've contributed $6,000 in 1 year and the next year something comes up and an emergency happens and you don't have set up an emergency fund and you don't have anything else, you could technically go into your Roth IRA, pull out the $6,000 and leave any of the gains you've made for the past year. You won't be taxed on that $6,000, or at least you shouldn't be taxed on those $6,000. Because again, since this is a pre-tax account, you are already taxed on your contributions originally. Now, there are some situations where they can waive the 10% penalty. Some examples are buying your first home, certain educational expenses, or some birth or adoption expenses. But you'll have to be very careful and make sure that you contact your financial institution to verify before you make the withdrawals. Now, here are some takeaways and some thoughts that I'd like to share regarding a Roth IRA. My recommendation is that everyone should have some kind of emergency fund. I use that as self-insurance in case anything were to happen. And I recommend doing that before you start a Roth IRA. My thoughts around that is a Roth IRA is meant for retirement. And you really shouldn't be touching those funds until you're 59 and a half or older, because you let the compound interest effect work and maximize your profits. So have an emergency fund of $1,000 to $5,000 set aside will help you cover any unexpected expenses in the future and will help you not dip into your Roth IRA. Another thing to consider is your expenses and your debts. Too many times people don't address those two things. It makes it very difficult for them to make any traction in their Roth IRA. or their retirement planning. Now, another thing I want you to consider is if you are currently employed and you have a 401k, especially if you have matching 401k, meaning your employer matches up to a certain percentage. Some employers match up to 3%, some 9%, some 50% of whatever it is that you're depositing or you're contributing. I would rather you contribute to that first than starting a Roth IRA. And the main reason is you want to take advantage of the match as much as possible. Plus, a 401k is basically a Roth IRA. They work very similarly, but typically you'll want to go with 401k first and max that out. Then you can open a Roth IRA. Now, if you have limited funds every month, again, that's another reason why you should just focus on your 401k first. If you were ever to change employers, that's fine because you can roll over your 401k to a Roth IRA later. And I've done that. I've rolled over a few 401ks into a Roth IRA when I've changed employers. Now, I highly suggest if you don't have access to a 401k that you open one immediately, because the sooner you can start, the more you're able to take advantage of the compound interest in the long term. Now, if you're able to max out your 401k contributions, then definitely start a Roth IRA to then contribute to that. That way you're taking full advantage of all the different tax shelters that are out there. Lastly, the reason why I say it's important to start a Roth IRA if you don't have access to a 401k, especially when you're younger, is because of the compound interest. Now, I'd like to give you a quick demonstration of why I believe it's important that you start a Roth IRA as soon as possible. And I'll do that with a calculator, and you can do this yourself. Just Google investment calculators and plug in certain numbers to show you how important it is to start investing sooner rather than later. Now, I have here, you're 25 years old and you're gonna retire at 60 years old, or at least that's when you were able to start with making withdrawals out of your Roth IRA. And if you make the minimum $500 monthly contribution, which is the equivalent of $6,000 a year, with an average annual return of 8%, you would have accumulated over $1 million for retirement. Now, depending on your lifestyle and your cost of living, that's plenty of money to retire off of, especially if you're gonna use the interest to live off of. Because you don't want to dip into the $1 million per se, you want to live off the interest that your investments are producing for you. So that's all I have. Hopefully this was short, sweet, and to the point, and you learned something today. If you need anything else, and if you want me to cover anything else, please don't hesitate to drop a comment down below. And if you're new, please don't forget to subscribe. I'd really appreciate it. I'm trying to get to 200 subscribers, so your support would be really appreciated. Don't forget to hit the like button. Smash that like button for me. It really helps me out as well. That's all I have. Until next time.